Hi, this is Ken Boyd with the Accounting Ed Training Academy and accountingaccidentally.com, and I wanted to take a few minutes to talk about how to define going concern in an audit and how that applies to something that is in the news right now. So the first thing I'd like to talk about is, what does going concern mean? So as you see on the Word document, going concern talks about company management and its responsibility to assess whether or not there is a substantial doubt about the ability of the firm to continue as a going concern. In other words, can the company keep operating? Well, what does substantial doubt mean? Substantial doubt is defined as it is probable that the business will be unable to meet its obligations. So the focus here is really on the idea of whether or not a company can pay its debts. That's really the focus. Now, management has some requirements. They must assess the going concern over a one-year period from the date the financial statements are issued. So if we issue our 2016 statements in May of 2017, we have a year going forward to assess going concern. Second bullet point, managers consider the dollar amount of funds necessary to meet the obligation. In other words, how much do we need to pay our debts each year? And is there a mitigation plan to remove the substantial doubt, whether it's issuing more stock, selling assets, some plan to prevent debt from impeding the company's ability to continue as a going concern. Now, when it comes to that plan, the statement here, and I've got a footnote here at the bottom if you want to look up the site, management has plans they believe will remove substantial doubt about the firm's ability to continue as a going concern. That would be a mitigation plan. So what do we need to do with that plan as a management team? We need to explain the conditions and events that raise substantial doubt. In other words, what was the problem? Second bullet, evaluation of the significance of the conditions or events that created the going concern risk. How significant is it? In other words, is the debt 30% of current assets, 65% of current assets is an example of a ratio you could use to assess it. And why is it that management's mitigation plans remove the significant doubt risk? All that's required of management. Unfortunately, this is as of April 17. There was an article in MarketWatch about iHeart Media. We have some iHeart radio stations where I am in St. Louis. It refers to iHeart Media as being the biggest operator of radio stations in the U.S. Plans to include language in its next quarterly report warning investors that it may not survive another year. Why is that? It continues to expect cash flow to be negative. It is uncertain as to whether it will be able to refinance or extend maturities of some of its borrowing. So your options, if you've got a heavy debt load, is refinance or extend the maturities. They talk about in this paragraph how the company took on huge amounts of debt in 2008, and that's really what's causing the going concern problem. So it talks about down here in a quote with an SEC filing, management anticipates that our financial statements to be issued for the 3 months ended March 31st, the first quarter, will include disclosure indicating there will be substantial doubt about our ability to continue as a going concern for the period of 12 months following the date that those first quarter financial statements are issued. So that's a little bit of an explanation of going concern using something in the news right now. Remember that the site, accountinged.com, we have dozens and dozens of hours of online accounting education, subscription-based site that you can try out for free. And you can also find my blogs and other information at accountingaccidentally.com. Thanks for watching, and we'll see you next time.